Good evening, everybody. In Accounting 110, this is Bob, and I'm going over today Chapter 110. We're going to skip Chapter 7, which deals with petty cash and bank reconciliations. We're going to skip Chapters 8 and 9, which deals with processing payroll, and we're going to pick those up toward the end of the semester. Today's lecture is going to be about credit sales and cash receipts. Most business in this country is done on credit. On credit, customers expect to have goods delivered to them and be able to pay for them in 30 days, perhaps. What happens, though, if you sell something and the customer returns it, or the customer takes a discount you may offer, or what if the customer bought it with a credit card? We're going to get into how to handle those very common transactions here. So let's see what we got. I'm going to see if I can hook us up with the PowerPoint here. And let's see if I can share this. Share and share alike, remember. Okay, I trust you can see that. I'm just gonna make it a little bigger here for my eyes. Oh, there it is. Now I can see it. All right, huh? Just give me one moment here to organize. Okay, accounting for cash, for sales and cash receipts. In this chapter, in the following chapter, we're going to be a merchandise outfit. We're a store. We're like Nordstrom's. We're like Target. We buy goods for one price, and we sell it for more money, and thus earn what's called a gross profit. We're going to purchase a garment from somebody, from a seamstress, and we paid $300 for that garment. That's the cost of the garment. That's the cost of goods sold to be recorded at the time we sell the product. So we sell that $300 garment for $1,000. Our sales, $3,000. Cost of goods sold, $700. So just a little basic reminder. A sale is a transfer of merchandise from one business to another in exchange for cash or for a promise. Who knew, huh? I bet you didn't know that before you came here. A retailer sells to end users, sells to customers, okay? When we buy something at Target, at Nordstrom's, we are buying from a retailer. They're selling to us, the end user. And when the retailer sells things, they need proof. They got to have their cash register receipts available, the tape, sales tickets, whatever. And here's an example of a sales ticket. This is kind of old-fashioned. Don't see this too much anymore, but it used to be you went into a store and they would write up exactly what you ordered and put it on here and then total it up and take your money from you. You know what store does this in town? One of our local clothing stores. I was there not long ago. That's exactly what they did. They wrote this up, my name and everything, put down one fancy tuxedo that I wear quite often, and then they handed me this thing, and you pay the bill. A wholesaler, that's the middleman. That's the guy who sells to the stores. He purchases directly from the manufacturer, okay? The wholesaler, he buys tons and tons of toilet paper from Kimberly-Clark, the manufacturer. And then the wholesaler sells it to the retailer, such as Target. And these transactions are on account for 99.99%. And they're just giving you a little bit of a process here. This is kind of old-fashioned, but I'm glad they're showing it because it just shows the flow of things. A customer turns in an order to us. Customer, it's their purchase order. To us, it's a sales order. We get that. We check their credit out if they're a first-time customer, and we get approval from somebody in the credit department that they are credit worthy. We create an invoice and send a copy of that invoice along with the goods on the way to the customer. And we, of course, we keep a copy in accounting, and shipping has to have one so they know what to do. And there can be other copies. Sales invoice, I mean, it's pretty simple. Again, these are handwritten types of things. But the point is, this guy bought 6 of these guys for $30. 5 of them for 400, and apparently they were not taxable, or they live in a non-tax, non-state tax, non-state tax state is what I'm trying to say. A credit memo issued by the seller. All it is, it used to be a formal piece of paper. Many years ago when I was doing this kind of work, the customer might call you up and say, I'm returning this toaster. It doesn't work properly. And we say to him, yes, you may do that, and I'll mail you the credit memo, which is just a piece of paper approving the right to return the stuff. Nowadays, it can be an email, a text, verbal almost, okay? And here's our credit memo. Remember, this person bought 8 of these or whatever it was. They're returning 1 now. The merchandise sales accounts. Now, here we go. Now we're getting into the innards of this chapter. Here's where we really want to put the old thinking cap on, huh? Merchandise sales accounts. We know that when we sell something on credit, we're going to debit sales. Oh, Jesus. We're going to debit accounts receivable and credit sales. You never debit sales. Never. Contrary to what I just spoke accidentally, you never debit sales. But you do need to reduce the amount of sales, if you will, by virtue of perhaps there's some sales tax involved, sales returns and allowances. Maybe there was some discounts involved. So let's take a peek here. And they're just starting you off with a few new things we haven't seen yet in the chart of accounts, and specifically here, the accounting equation, okay? So you have sales, credit balance, credit. You never debit sales. I've got the guitar right here. I may do the never debit sales song, but hopefully you don't need me to torture with that. You never debit sales, but you do have to reduce the sales number, which we will call gross sales. Gross sales. We will reduce this gross sales number by debiting 3 sales contra accounts, 3 contra sales accounts, contra revenue accounts. These are sales accounts, but they carry a debit balance. They're outliers. This is the same exact thought process as accumulated depreciation. Just like we never credit the original cost of a piece of equipment or a building or land, here you never debit the sales. You're never gonna decrease that number on our general ledger. We always want to know how much we actually build out, and we want to separate how much of this we're not likely to collect because customers returned something to us, customers took advantage of a sales discount, which we may give them if they agree to pay us early, or they may have used a credit card, which means if they bought something from us for $100 and the credit card fee is 2%, we're not going to get $100 in our bank account. We'll just get the 98. And that $2 difference would go into these contra sales accounts. Sales account is a revenue account. Very simple, huh? $100 sale for cash, debit cash, credit sales. Okay, that enough with chapter 1, huh? If the same sale is made on account, well, we know this. We're going to debit accounts receivable and credit sales. We haven't been paid yet, but we know right now for sure, right, that we record the sale, that revenue, at the point of the sale or when the service is performed. It has nothing to do with the cash. Sales tax payable. Whoa, we all know what this is. In Santa Barbara County, I think it's 8.75%. I'm not quite sure. That means you buy something for $100, it's going to cost you $108.75. This is a liability account that the selling company has to have on their general ledger and control. They are required to collect this, and they collect it when they get paid by the customer, okay? They get paid, they get this money from the customer, and it is the company's responsibility to remit it to the, in California, it's called the State Board of Equalization. This is not the company's money. This is the customer's money that he is entrusting us to turn over to the state. So here's a simple example, and I know you'll have this kind of journal entry on the next exam. Cash sale for $100, 5% sales tax. How much cash will this company receive? $105. Only $100 is the merchandise. The $5 is the sales tax payable. Now, if this was accounts receivable, when we get paid, we would credit the accounts receivable. Here, they turned it into a cash sale. Okay, here we go. They're giving us the other example. They're really covering all the bases in this chapter, huh? If it's a sale for credit, credit, the sales tax would be 5% sales tax payable. The merchandise, we sold them a $100 shirt. Accounts receivable, 105. The customer owes us $105 because we charged them sales tax. The sale, though, was only 100. The sales tax cannot be put in with the sales number. So let's look at our first contra revenue account. Sales returns and allowances, huh? In a typical chart of accounts, you might see sales with the GL number 400. Sales typically begin with a 4. So we'll say 400 is the number for sales. Sales returns and allowances would probably 400.1 to indicate with that .1, it's a contra account. So a contra revenue account is used to record sales returns and allowances, has a normal debit balance because you never debit sales. Never. And it's going to reduce our gross sales. And this account is debited rather than sales so that the business can more readily keep track of this type of activity. Now, if you did debit sales because you didn't know what you're doing, the financial statements would come out okay, but this company will lose an opportunity to examine what truly happened. This company wants to know how much of our stuff is being returned to us. Why is it being returned? Do we have a policy where we're too lenient taking returns back? That's the kind of information you need to separate into the sales, returns, and allowances account. So here is a credit memo, meaning we gave this customer permission to return the product. We had charged Wilma Cuts $48.30. That's what we had debited. Now we're crediting that because she no longer owes us the $48.30. The $46 is part of this. The $46 is the merchandise. We sold her a book or something for $46, and now she no longer owes us the sales tax, so therefore we no longer owe it to the state. So look at these journal entries. This is a big gist of this chapter. Sales returns and allowances. This I am not getting into. And I'll bring this to Cornelia's attention. In this Cengage book, they're introducing something called estimating sales returns and allowances, and I'm simply not going to get into that. I've never seen it. Our whole faculty looked at that, and we all shook our heads and said, no, we're not going to go in there. Trust me on that, okay? If you get a question on that on the test, you're not going to get hurt, okay? Okay, we did sales returns and allowances. Now we're talking about what's called a sales discount, also called a cash discount, a sales discount. This is not you walking into Target and you're ready to buy a big container of Tide detergent and you see a sign next to it, $3 discount or 20% discount. That is not what we're talking about. What we're talking about here is a specific kind of discount that sellers offer their customers in an attempt to get them to pay the bill early, okay? And the customer has the choice. He can either pay the full amount or she can take a discount, They offer cash discounts to encourage prompt payment. And if you do that, you take care of your receivables, you drive your turnover number up, your days of receivables down. It's a good thing. Sales discounts. Now, here is what we mean by a sales discount. It is typically expressed like this: 210 net 30, 210 net 30, 2% discount off the sales price if the customer pays within 10 days. Otherwise, they pay the net, meaning the total. 210 net 30, 2% 10 net 30. You have to know that like you know your own name. 2% 10 net 30. Customer, if they pay within 10 days, can take a 2% discount. But if they don't pay in 10 days, they must pay the whole amount in 30 days. Same thing here. 1%, 10 net 30. 1%, 10 net 30. Here's one I've never really seen too much. 2% end of month, net 60. You sold something to somebody on the 15th of the month. Well, you're in essence giving him 15 days to think about taking a discount. Or it could be 3% 10 end of month. You understand these numbers can be whatever the customer wants, whatever the seller wants to offer. Doesn't have to offer cash or sales discount at all. But it's a contra revenue account, huh? So look at this here. This merchandise was sold with credit terms of 210, right? 210. So they debited accounts receivable for 100 and they credited sales. We do not worry about the discount at the point of sale. We can't, because we don't know if the customer is going to take advantage of our generous offer of 2%, 10 or whatever. Now we sold this on day one, then 3 days later, within the 10-day period, they're saying 2%, 10, net 30. 3 days after we sent them this bill, we got the check in the mail. But the check is only for $98. They owed us 100, so they are removing that $100 debt by paying us 98. The difference of $2 is a debit to sales discounts, a contra revenue account, because you never debit sales. What you debit are these contra sales accounts, okay? The accounts receivable ledger. We'll talk about this here. I think that this slide is out of order, to be honest with you. Let's look at some journal entries, okay? We're selling something to Enrico Lorenzo. I'm not going to make any jokes here. And then we sold some to Brenda Meyer, Edith Walton, Wilma Cutts, and Heidi Schweitzer, huh? So let's see what we have here. We sold something. We sold $1,500 plus $76 in sales tax to Enrico Lorenzo. Let's look at this. I trust you can read this. I trust. Oh, I can zoom. Zoom. Man, I'm getting hot now using some of these bells and whistles, huh? Okay, we sold something to Edgardo Lorenzo. We sold him. Oh, look at this. This is on the wrong line. Can you see that, guys? This should be down here. Every one of these things, right? We sold it to him. The sale was, no, that's right. That's right. I thought for a second this was a header. Okay. I'm glad you pointed that out to me. We sold him $1,520 worth of merchandise, okay? Keep in mind that the sales line in your general ledger on any journal entry you prepare is always going to be the units sold times the price per unit. You will never have anything in this column, not column, but in this row here, the sales row, except whatever the extension of the units are. So we sold something for $1,520. We charged the customer $76 in sales taxes. Therefore, this customer owes us $1,520 $596, huh? Not too tough. And it looks like the next item here, I'd like to go back up just to take a peek. You know something? I think I have to unzoom. Okay, the next two transactions to Brenda Myers and Edith Walton are pretty much the same thing. Merchandise plus sales tax, merchandise plus sales tax, merchandise. So these are all the same type of transactions, okay? You sold something to Brenda Myers. The sale, we sold a $440 piece of clothing to Brenda, and we charged her the sales tax of $422. The AR is the $462. Okay. The accounts receivable is where you will put the offset to the sales tax payable. Here, we sold something to Edith Walton. We sold a $980 computer. The sales tax was $49. You add it up, that's $1029. That is AR, etc. with Wilma Cutts and with Heidi Schweitzer. So this particular slide, of course, you guys all have the slides in Canvas in the chapter module. This is a good one to look at a little bit till it becomes automatic. Yeah, we sell something on credit. We sold it on credit. We're going to debit accounts receivable, and we're going to credit sales, and there was some sales tax. So that's a 3-line entry. So now what we're going to do is we're going to post those transactions to the general ledger. And we know how to post to the general ledger. We enter the date, the amount, blah, 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 maybe a reference. So let's see what we have here. Here is our general ledger, partial, of course. General ledger. So let's see what we have here. Here is accounts receivable. That's our general ledger account number 122. That makes sense. So the balance at the beginning of the month was $12,000. This is what customers owed us at the beginning of the month from sales, obviously, prior to the second quarter. And we just saw that we had a couple of sales here, 1596, 462. They're not showing all of them. They're showing the first two transactions. So this was Edgardo Parenti, or whatever his name was, Lorenzo Parenti, and this was the second lady. So what happens in the general ledger? Our balance goes from 12,000 to 13,596, etc. We add up, and we would do that for all 5 of those transactions. Sorry, I got the happy fingers sometimes with this thing. Sorry. Okay. Now we know that from the transactions that there was sales tax involved. So here is our debit to accounts receivable, and here are our 2 credits. Notice it's in the credit side, or 2 credits representing sales tax payable, and here's the sales number. Okay, so that's not too tough, huh? Not too tough. And here they're showing you the journal entry. This is just a repeat of what we saw on the prior page. So we want to get familiar with these easy sales transactions. In this chapter, we're doing sales. Next chapter, it will be cost of sales or cost of goods sold. Well, we posted this to the general ledger, huh? But we have to keep track by customer too, don't you think? We want to call up Parenti and say, how come you haven't paid us? And he may say, I don't owe you any money. Here's what we do. We maintain a separate ledger called a subsidiary ledger. I think this is the first time we're using this expression, a subsidiary ledger. It means subordinate to the general ledger. The general ledger has less detail. Here is accounts receivable, but it doesn't necessarily tell you who the customer is. What we're going to do now is we're going to have a separate ledger-like item for Lorenzo and Myers. Each customer gets an account number, not a general ledger number, but customer number, such and such. And we're going to track their accounts receivable balance. And guess what? The balance in their individual accounts must add up to what's in the general ledger, okay? So how do we post to their ledger? It's pretty much the same way we did with the general ledger. So let us take a look. Here are the two transactions. Here is what we just reviewed down here. Now we have to put these two transactions into the subsidiary ledger. So notice that Enrico Lorenzo, he has his own page. Brenda Myers has her own page, and so do all of our customers. So when we recorded this debit here, 1596, we had to add that as a debit here as well. We had to post a debit to increase the balance that Lorenzo owes us. Same thing with Brenda. We charged her $462, including the sales tax, so she now owes us $462. When Lorenzo pays us, you'll see it on that side, and we'll reduce that down. So the general ledger, that's the general ledger, right? The books of the company, like we talked about a little bit. The auditors come in, and they're going to say, how much did you have in accounts receivable? And we say, well, we had $14,058. They'll say, oh yeah, who owes you that money? And we're going to show him this subsidiary ledger. And he's going to look at this. That's a pretty big number, huh? 1,500. What he's going to do is he's going to have us sign a form letter to Mr. Lorenzo, and it's going to say, dear Mr. Lorenzo, can you verify that this balance is correct, that you did owe this money as of April 20th? And he replies, as we hope he does, is a good customer, wants to keep him in good graces. And the auditor will go from there, their next step in verifying these numbers. Relationships to remember. Entries in the general ledger. After the posting of the accounts receivable ledger and the general ledger, guess what? Total of all of the accounts receivable ledgers balances have to equal the accounts receivable balance. It would be a horrible thing, wouldn't it? If we said we owe 14,058 and these are the only two we could find, we'd have a big problem. I would have to think in this modern age, you would probably very rarely run into an instance where these were out of balance. Just like I know you can't post an out of balance journal entry anymore. Your system is probably going to do this part as you do this simultaneously. There'll be a code or some way to do that, okay? But they have to be in balance. So now let's talk about sales returns, okay? Sales returns. Let's look at this journal entry. Wilma Cruz, remember her? We sold her 600, and we sold her so much in sales and so much in sales tax payable, okay? So what happened here? We gave her permission to return the goods. So we had charged her a total of $651. She doesn't owe us $651 anymore. She owes us nothing. So let's see what happens here. Let's see here. She sold 48. I just want to see if she returned everything. Yeah, she looks like she returned everything. So we are going to credit accounts receivable up here because she no longer owes us the 48.30. And we're also going to credit her individual account. So she owed us $651, and now she's returned $48.30, which brings her debt to us down. We've wiped out the entire accounts receivable, and now we get a chance to reduce the sales tax payable. Because when we charged her for the sales tax on $563. She doesn't have to pay the sales tax anymore on what she returned. And the sales returns and allowance is debited. This is your contra account. I'm going to repeat what I said before about sales. The sales number will always be a multiple of the units sold times the selling price. The same thing is true for your sales returns and allowances. Okay? Sales returns and allowances, debit balance, a contra. Here we go, credit cards. Similar to cash sales, as far as I'm concerned, credit cards are cash. In my class, credit cards are cash, okay? Because you're going to get the money pretty darn quick, and there's no question you're going to receive it. It's cash. Credit card transactions are cash. But if someone uses a credit card to buy something from us for, say, $100, when we look at our bank statement an hour later or early the next morning, we're not going to see $100. We're only going to see like 98, because the credit card company takes $2 out of every transaction. Okay. So here we go. We sold something to somebody for $100, and there was sales tax involved, $5, and he used a credit card that has a 4% fee. Wow. Boy, this is getting complicated here, huh? So let's see what we have. We sold $100. That will always be a multiple of units times price. The sales tax is $5, so that's 105. The expense is $4.20. 4%. 4% of 100. You know something? This is probably supposed to say 4.2, and they're here it's 420. Here it's 4%. Anyway, we'll say 4.2%. So the credit card expense is $4.20. These two items less this is the amount of cash we will receive. Again, the credit card sales, credit card fees, credit card expenses. Let's not call it expense, though. That's not right. It is a contra revenue account, okay? That contra revenue account has a debit balance to offset the credit to sales, which we never debit. Never. So let's look here. Looks like we have the same people, Enrico, Lorenzo, and Brenda, and Edith. And now some of these people are paying us. Let's see if Lorenzo paid us. I think he's a good customer. We'll see. I don't trust that Edith for some reason. Maybe I'm being silly. Okay. Let me take a quick peek here. Okay. Come on, zoom, will you? Zoom. Okay. All right, let's see what happened here. Let's see what happened, huh? Well, Lorenzo paid the whole bill. He paid the whole bill. That's nice, huh? So we debit cash. We credit accounts receivable. And in that accounts receivable, if you remember, there was $76 worth of sales tax payable, which we now have to mail into the state board at the end of each month, huh? Same thing here. Brenda was nice enough to pay the entire bill. We debit cash and we credit accounts receivable. Walton, the same thing. Walton, the same exact thing. She paid us, we reduce accounts receivable. Now, this transaction on the 30th was a cash sale. A cash sale. So what? It just means we don't have to worry about collecting money later. We don't even have accounts receivable if it's a cash sale. This is what we like, right? So we are going to debit cash for the sale amount of $36.80 plus the 3%, I believe. I think that's 3%. Actually, 5% sales tax, $180. $3,780 is what we received from this customer. We love those cash sales, huh? And what else do we have? This last guy, well, he bought a lot of things from us. Wow. Holy cow. This guy bought a used car from us, a pretty good used car, huh? We charged him $22,500 for that car. One car times $22,500 times 5%. to get the sales tax payable. But look, he's paid with a credit card. So you have to take the sales number and multiply it by the appropriate percentage to get the 900. Okay. And it looks like it was 4%. If you do the math, this is good. 4 times 225 is 900. So the sale, the merchandise price times the units, sales tax payable is multiplied by that number. The credit card fee number is going to be reducing the sales number, but since you can't debit sales, you must debit the contra account called credit card charges. I don't like that word expense. Charges would be better. And these two numbers, there's the cash. So I don't think it's too bad so far, this chapter, huh? Let's see what other goodies they have. Oh my goodness. Well, here, they're just showing you the other side of the coin. Remember when we sold to Lorenzo? It looks like it was a cash sale. I mean, it looks like these two were cash payments made by Lorenzo and Myers. They're sticking with a Lorenzo. So let's take a look here. Cash. We got $15.96. So of course, that's a debit, which increases the balance from $20,000 to $21,596. But the asset accounts receivable goes down by that same amount. Obviously, he does not owe us this money any longer. It's an exchange of assets, if you will. We gave up one current asset, accounts receivable, for our favorite asset, cash. It's the same thing with Miss Myers. She wrote a check for $462. Here's cash in your general ledger. We debit it. And here is the accounts receivable in the general ledger. Whatever we do in the general ledger has to come over to their individual account. Well, he had a balance of $15.96. Uh-oh, he paid us. That brings his balance down to zero. Ditto for Miss Myers. Okay? So what we're trying to learn here is that we have to record all these sales transactions, these cash receipts, these returns to customers, things like that. We have to record them, of course, in the general ledger. And whatever we do in the general ledger has to be duplicated in the subsidiary customer ledger, the accounts receivable subsidiary, let's call it. And this is what we were just looking at, huh? So let's take a peek here, because I think I know where they're going next. Our balance as of the 20th was $13,029. That's how much money all of our customers owed us in total. So these different customers, the 5 customers I think we had, that number better add down to that number. And the way to prove it, we're going to prepare what's called the schedule of accounts receivable. Pretty easy stuff here. All we're doing here is we're going to list all of our customers who owe us money, probably do it alphabetically, put in the balance and add them up and make sure that it adds to the general ledger. If it does not, we have a severe problem, okay? So the accounts receivable, it's just a list of the customers and what they owe us. Could be alphabetical, numerical, you can do it any way you want. Do it at the end of the month, but you might do it every so often. You know, sometimes the boss will come out there and say, show me who owes us money right now. And that total has to equal the general ledger. So here we go. As of the 30th, Helen Avery, and they're doing them in order by first name. I don't think I've ever seen that before. But okay, they're doing it in order. Oh no, they're doing it alphabetically by last name. I'm sorry. Avery Kutz Spritzer. Here we go. Avery owes us $2302,651. These add up to $14,331. This is as of April 30th. The number we looked up before, that 13,029, was as of the 20th. So here they've had some more transactions that they haven't told us about yet. So you look in your general ledger, that's going to be the balance in accounts receivable. And like I said, your auditors are going to come in and they're saying, what's your accounts receivable number, please? And you show them 14,331,000, probably, right? And they'll say, please show me your ledger. And they're going to use this ledger like the Bible. And their procedure might be that they want to cover at least $8,000 of this. So they're going to probably go to your two biggest customers, this guy, this person, and maybe someone else. And like I said, they're going to contact them and make sure that this debt is correct. I mean, there was so much fraud 20 years ago with companies like Enron and WorldCom and the cable TV guy, Adelphia. This was one of the many scams they had going. They were billing their brother-in-law. And then the brother-in-law would write back to the auditor saying, yeah, this is good. And if the auditors didn't do some extra steps, they might have gotten away with it. Accounts receivable errors. Oh, goodness. I think we know what we're talking about with errors. Go back and double check. That's all, okay? So this chapter here is not too bad. I am going to ask you to stay with me just a little bit longer because I want to show you something here. This is a problem from Accounting 230 when they're just starting to learn this, okay? And can you read this? Let me see if I make this bigger. Give me one quick second here. Oh, come on. Try it one more time. I have a feeling that you all can read this and I'm worrying about nothing. Okay, all right, I'm not going to get any better than that. Let me try this. Okay, what I'd like to show you here is, this is a typical problem. They're saying here, we have the following transactions with Cadence retailers, and you can see they sold 20 items at an invoice price, 3%, 10 terms, sold 2 items of merchandise to this other customer C, and he or she used a credit card, and that credit card fee was $400, which was 2%. And then we have another sale, 10 items, totaling 9,000, meaning they were each 900. And in the next transaction, that customer D returned one of those items, and we have to record that. Then customer D paid the bill, and customer B paid. And they're asking you to work out the schedule here, okay? I am going to show you the easy way to do this. When you guys get smart, meaning I don't want to say smart, you're all smarter than me, but when you do enough of these problems, you might even be able to do this in your head almost. You know, you could say, well, let's see, this is 5,500 and this was so much, and then let's deduct the 400. And that can be a little tricky trying to do the math in the head. So what I'm going to show you here is the Bob recommended way. The Bob recommended way. Here we go. Here we go. Let me move this out of my way. This is the same problem. I just copied it over. We sold something to company B, customer B, huh? And it's $5,500 with 3%, 10 net terms. This happened on the 20th. So what happened on the 20th? We sold $5,500 to this guy. Sold $5,500 to that guy. And sales. At this point, they're not talking about sales tax payable. What happened on the day prior? We sold something for $400 with the credit card fee. We sold something for $400. So the $400 is the sale. The $400 is the sale. But the credit card fee, which is a contra revenue count, is the 4%, $8. 4 times 2 is 8, right? Therefore, the cash we received in that deal was only $392. Quickly go through the last couple. Sold 10 items for $9,000. 10 items at 900. So the sale was 9,000, and they owe us $9,000 at that point. Okay. What's the next transaction? Customer D, this guy here on the 28th, customer D returned one of the items on the 28th. Good gosh. What do we do with this? Well, we know we have to debit the sales returns and allowance account. Of course, we never debit sales. So here's your sales returns and allowance account, and it's for 900, not 9,000, because he's returned only one of the $900 items. That goes down. That goes up, rather, to reduce overall net sales. Accounts receivable goes down. This person doesn't owe us that $900 anymore. They returned it. Let's see what we got here to finish this. Then that same guy paid us his balance in full. Well, when did we sell to this fellow? Well, we sold to customer D on the 28th, and he's paying us on December 6th. Is he entitled to take that discount? Yes, of course, because it's within the 10-day time frame. If this was 3% 5, then that would be no good. So we gave him 10 days to pay, and he paid us. So let's take a peek now. But he did not owe us $9,000 anymore, right? We sold him 9,000, and he's returning 900. And guess what? Guess what? I can't get to my clicker up here. There we go. That's $8,100. That's how much he owes us, and that's how much he paid. 81. That's not how much he paid. That's how much he owed. 8,100. So let's do that part. But he paid us within the time frame, and that was a 3% discount, right? That was a 3% discount. Ooh, what happened here? Okay, this was a 3% discount here. I'm just prettying it up. So how much did he reduce? Oh, for heaven's sake, plus 81. Thing gets on my nerves. $243. We sold him 10 items at 900 each on the 28th. On the 29th, he returned 900, leaving him with a debt to us of 8,100, and he's entitled to $243 of relief because he paid us on time. So that's good. And what is 8,100 minus 243? If there's a God in heaven, it's 78.57. 8,100 minus 243, just to show you that I didn't have one of my little brain cramps here. 78.57. You get the hint on doing them with T accounts. T accounts are your friend. Well, it looks like we only have one more transaction, and I'm assuming that somebody paid us. So let's see. All right, customer B paid us. He paid us on December 20th. When did he buy the stuff? A month ago. He is not entitled to a discount, so we have to collect the whole $5,500 from this guy, right? Debit cash. Credit accounts receivable. And there you go. Now, I went very, very slowly doing that. So you could answer this question, and it is a problem from 230, so maybe a little more extensive, but this is what our whole chapter is about. So here is the top of our income statement now. We're going to have something called gross sales, meaning everything we build out, gross sales, otherwise known as sales, gross sales, okay, sales. Normal credit balance. All of these offsets are contra sales accounts, which carry a debit balance. So 14,900 minus that, minus that, minus that equals 13,749. 13,749. Okay. I just wanted to go through that brief Excel presentation. So we pretty much covered some guts of this chapter here. You know where to find me. You know what my tutoring hours are. You know when Alan's available for tutoring, and you also know you're always welcome to call me, text me whenever you need something. Okay. And I guess I'll let you go now. And I will not pick up the guitar and do the You Never Debit Sales song, because you should know that by now. Okay. All right. You've been a great audience, ladies and gentlemen, and we'll see you later on. Okay. Hey, bye-bye.